Hello there and welcome. This is Module 2 of the AAM Advisory Consumer Awareness Guide video series about the things you need to consider when hiring a financial advisor. In this video, I'm going to talk about 5 costly misconceptions that many people hold about the financial services industry. To begin with, many people seem to believe that all financial advisors and representatives are exactly the same. Secondly, they perhaps think that diversification means using multiple advisors at different companies. The third misconception is the idea that financial advisors require the completion of a rigorous and very specific education. Fourth, they perhaps think that the only role a financial advisor holds is to pick investments. And fifth and finally, they believe that minimizing charges will always and inevitably result in better results. I'll deal with each of these misconceptions in turn, but before doing so, I need to remind you that because AAM Advisory is a licensed and regulated financial advisor, you must be aware of the legal notices pertaining to this video series. You can read these legal notices in full by clicking the disclaimers link at the foot of our website. To keep it simple, however, and in plain English, it means that you're an adult, and as an adult you must be responsible for your own research, your own decisions and the actions you take. You should not, on the other hand, rely on the information presented in these videos. Because whilst we strive for accuracy, we cannot guarantee it. Okay, so having said that, let's move on. The single biggest misconception most people have when it comes to investing is that all financial advisors are exactly the same. Perhaps not surprisingly, this is not necessarily true. You see, while most financial advisors and representatives do offer similar products and platforms, the recommendations that an individual advisor makes will be dictated by their own knowledge and experience. They will also tailor the advice to the needs of each individual client and their circumstances. Finally, you must also take into consideration the fact that each company will have its own corporate culture, and this can greatly influence each representative that works for that organization. So to sum up, all financial advisors are not the same. Misconception number 2 is the belief that diversification means using multiple advisors at different companies. The answer to that is it's simply not true. On the contrary, diversification is all about spreading your investments using multiple different types of investment and asset classes. By doing so, you reduce the chances that all your investments will rise or fall at the same time. If, however, you work with multiple advisors, then the risk is that they will give you conflicting advice and recommendations. Now, this would obviously lead to confusion and possibly substandard results as well. The solution is to seek out and hire one advisor that you trust and whose investment philosophy is aligned with yours, or you at least find yourself in agreement with it. One top quality advisor will give you all the diversification you could ever need. The third misconception is that to be a financial advisor requires completion of a rigorous and specific education. Once again, this is not strictly true. There are courses that are available which teach and prepare individuals for a career as a financial advisor or a representative, and in many places you do have to pass specific examinations to be a financial advisor. More importantly, however, the crux of the knowledge that most financial advisors acquire is through self-teaching, mentoring from a senior colleague, and from training and development classes offered through associations by investment companies and colleges. What is true is that all individuals who are acting as a representative for a licensed financial advisor must hold a representative's license, and they must meet minimum entry and examination requirements and conduct their business in a very specifically and professionally guided way. As a note of caution, however, it is important that you understand that just because an advisor holds a license, it doesn't necessarily mean that they are competent or experienced. This is why it is imperative to ask your advisor about their experience and their track record of achieving proven results for his or her clients. Misconception number 4 is thinking that the only role of a financial advisor is to pick investments. This is true of a stockbroker, but not necessarily of a financial advisor. Most financial advisors are licensed to recommend an assortment of investment and insurance products as possible solutions to your financial needs. Your advisor should work with you to develop a comprehensive understanding of your unique situation, so that they can advise you when making decisions which will impact your financial security. Ideally, you want an advisor who provides guidance and advice in all areas of your financial life that fall within their regulated activities and remit. Okay, misconception number 5, last but not least. This is the belief that minimizing charges always results in better performance. Again, it might be true, but it isn't always. Of course, charges are important, and it does make a great deal of sense to minimize them whenever possible. Nevertheless, studies have shown that performance results over time tend to have a high correlation with emotional decisions. Now let me explain that in a bit more detail. While many investors who make financial decisions on their own can keep overall investment charges lower, they tend to make decisions based on emotion during periods of market distress and market euphoria. These emotional driven decisions unfortunately have a negative impact on their long-term performance results. The flip side is, while those investors who work with a financial advisor may pay higher fees or charges over time than investors working on their own, they generally tend to realize better long-term performance results. The end result is that in many cases it comes down to an investor's ability to maintain their investment discipline during periods of market turbulence. This is always easier to do if you have a competent professional advising you and looking after you. Okay, so that's the 5 costly misconceptions about the financial services industry suitably debunked. Thanks for watching, and we hope that you enjoyed this video as much as we enjoyed making it for you. If you did so, feel free to share it with your friends. It's really easy to do so, because all you need to do is click any one of the icons you see below the video. And just before we go, we'd really appreciate it if you could click the I like this icon just below, and if you would like to, leave a comment as well. We'd love to hear your thoughts on this Module 2 video. Thanks very much for watching.